Hello and welcome to Web3 Diaries. I'm your host Shikha Singh.
Hello, I'm your host Roshni Shingre, giving your daily dose of new snippets from the Web3 universe.
Hello, I am your host Vishakha Thakur. Let's start with the news for today. Microsoft has been threatened with a lawsuit from Tesla and Twitter CEO Elon Musk, who claimed the big tech firm illegally trained its artificial intelligence on Twitter data. On April 19, Musk tweeted that it was lawsuit time in response to a post reporting that Microsoft would cease supporting Twitter on April 25 across its online social advertising tools, smart campaigns, and multi-platform. The Twitter boss alleged Microsoft trained illegally using Twitter data, implying the firm mined user tweets to help train its AI-powered applications. Microsoft did not explain why it was winding down Twitter support, although Twitter's API fees skyrocketed from $0 to $42,000 a month and in some cases are priced upwards of $200,000 per month, according to a March report from Wired. Musk made further allegations that Microsoft is demonetizing Twitter data by removing advertisements and then selling our data to others. Microsoft's decision to ditch Twitter means its customers will lose access to their Twitter accounts through its tools in addition to being able to create, manage, view, and schedule tweets. Facebook, Instagram, and LinkedIn remain available to Microsoft customers, its website states. Microsoft's decision comes a few months after Twitter stopped providing free access to the Twitter API for versions 1.1 and 2. The software company is now reportedly developing its own AI chips to power ChatGPT to deal with the rising development costs for in-house and OpenAI projects. With a $2.15 trillion valuation, Microsoft is behind only Apple as the second largest company in the world by market cap, according to Google Finance. Over to you, Shikha.
As the rush to claim dominance in the artificial intelligence space hots up with Microsoft Elon Musk's big investment plan, Nvidia is set to provide tough competition with the only analyst with bearish view changing the graphics chip maker's future outlook. HSBC head of technology research Frank Lee changed Nvidia's rating from reduce to buy, pointing to opportunities in artificial intelligence. Lee was the only analyst among 48 covering Nvidia, held a negative rating on the chip maker according to Refinitiv data. Nvidia's stock price rose as much as 4.1% after Lee said in a research note that the company's artificial intelligence opportunity more than offsets his previous concerns surrounding a slowdown in data centers and rising inventory levels. HSBC analysis estimates robust demand for AI chips, which will result in market price increasing 10 to 20 times higher than standard gaming chips found on laptops. This prediction indicates Nvidia chips price will automatically hit a high value trajectory without increasing sales volume. Lee lifted his price target to $355 from $175. That compares to a median price target of $298.50. Nvidia's 91% rally so far in 2023 makes it S&P 500's top performing stock during that time. The Silicon Valley company's stock has rebounded about 150% from its low in October. Nvidia on February 22nd forecast first quarter revenue above Wall Street estimates, with CEO Jensen Huang telling analysts that use of its chips to power artificial intelligence services like chatbots had gone through the roof. Nvidia dominates the entire generative AI sphere, hitting 90% market share in 2024, well ahead of conventional competitors like Intel, Micron, and Advanced Micro Devices. With a market capitalization of $687 billion, Nvidia has become the fifth most valuable company on Wall Street, trailing only Apple, Microsoft, Alphabet, and Amazon, and beating Tesla by about $100 billion. Nvidia's shares remains down about 17% from the record high close in November 2021. Investors have been betting that Nvidia will become a dominant chip supplier in emerging wave of artificial intelligence computing, even as the global semiconductor industry weathers a downturn in sales due to worries about the economy. Over to you, Roshni.
Bankrupt cryptocurrency lender Voyager Digital Holdings has sealed a deal with the United States federal government that moves forward a $1 billion plan that would allow Voyager to sell its assets to the US arm of Binance. An April 19th filing in a New York district court saw Voyager, the official committee of unsecured creditors, and the US government agree that the deal for Binance to acquire Voyager's digital assets could move forward as planned. The filing states the government can continue to work on an appeal of exculpation provisions, what it claims are conditions allowing Voyagers to be protected from certain legal liabilities. The Voyager Officials Committee of Unsecured Creditors stated in a series of tweets on April 19th that all parties agreed on the resolution provided the appeals will continue with respect to the planned exculpation provisions. Previously, the deal with Binance.US was temporarily halted by a federal judge after a request by the US government for an emergency stay. US regulators have made several attempts to halt the deal ever since it was granted approval to proceed on March 7th by US bankruptcy judge Michael Wiles, who noted that delaying the deal will harm the interest of Voyager's former clients waiting to receive funds. A week after it was approved, the government requested on March 14th to delay the bankruptcy plan by 2 weeks. It accused the bankruptcy plan of immunizing fraud, theft, or tax avoidance. However, the motion was denied by Judge Wiles, who said the accusations were exaggerating and mischaracterizing. A Feb 28th court filing revealed that 97% of the 61,300 Voyager's account holders were in favor in the deal with Binance.US. Voyager has been actively taking steps to coordinate the plan for the redistribution of funds to creditors since its filed for Chapter 11 bankruptcy in July 2022. That's all in today's Web3 Diaries episode. For more such updates, watch 3.0 TV. Thanks for watching.